Hello everyone. Today we're talking about a big banking story. Regulators seized First Republic Bank and sold its assets to JPMorgan Chase and Company on Monday, in a deal to resolve the largest U.S. bank failure since the 2008 financial crisis and draw a line under a lingering banking turmoil. First Republic was among regional U.S. lenders most battered by a crisis in confidence in the banking sector in March, when depositors fled en masse from smaller banks to giants like JPMorgan as they panicked over the collapse of two other mid-sized U.S. banks. The bank had limped along since then, but investors fled again last week when it disclosed more than $100 billion in outflows in the first quarter and a plan to explore new options. Barely a week later, California regulators on Monday seized First Republic and put it into FDIC receivership alongside the sale of its assets, marking the third major U.S. bank failure in 2 months and the largest since Washington Mutual in 2008. Shares of JPMorgan rose 2% on Monday, while those of mid-tier banks fell and the KBW Regional Banking Index closed down 2.7%. First Republic shareholders will be wiped out in the transaction, Wedbush analysts said. The First Republic Bank's shares dropped 43.3% in pre-market trading on Monday before they were halted. JPMorgan will pay $10.6 billion to the U.S. Federal Deposit Insurance Corp, FDIC, as part of the deal to take control of most of the bank's assets and get access to First Republic's coveted wealthy client base. Our government invited us and others to step up, and we did, said Jamie Dimon, JPMorgan chairman and CEO, who had been a key player in the 2008 financial crisis as well and bought Bear Stearns in a weekend rescue. The deal will cost FDIC's deposit insurance fund about $13 billion, according to the regulator's initial estimate. U.S. President Joe Biden on Monday hailed the deal for protecting depositors without making taxpayers foot the bill. He repeated his call for stronger bank regulation and supervision. These actions are going to make sure that the banking system is safe and sound, Biden told an event at the White House. Critically, taxpayers are not the ones that are on hook. The White House praised decisive actions taken by regulators to protect depositors and keep the banking system stable. White House Press Secretary Karine Jean-Pierre said the actions would also ensure that First Republic, which she said was severely mismanaged, would be held accountable. JPMorgan has assumed all of the bank's deposits, it said, and will repay $25 billion of $30 billion big banks deposited with First Republic in March to help it. The failed First Republic Bank's 84 offices in 8 states will reopen as branches of JPMorgan Chase Bank. So, let's break this down a bit. What does it mean for JPMorgan to take over First Republic? Well, first, let's talk about why First Republic failed. The bank, which specializes in lending to wealthy clients, saw over $100 billion in outflows in the first quarter of this year, which panicked investors. With investors pulling out, the bank didn't have the liquidity it needed to keep its doors open. This is where JPMorgan comes in. They're buying First Republic's assets and taking over most of the bank's operations. But why is JPMorgan buying First Republic? Well, it's not just because they're feeling generous. They're paying $10.6 billion to the FDIC for First Republic's assets and the opportunity to acquire First Republic's wealthy client base. And let me tell you, that client base is something that many banks would love to get their hands on. But not everyone is thrilled about this deal. Some people are concerned that the biggest banks are getting stronger while it's getting harder for smaller banks to do business. Dennis Kelleher, CEO of Wall Street reform group Better Markets, said in a statement, "The mega banks have already been allowed to grow too big to fail, and this merger only exacerbates that problem." Kelleher's concerns are not unfounded. As banks continue to consolidate, they become larger and more interconnected, which can create systemic risks to the financial system. In the event of a bank failure, the fallout could be more severe and widespread than it would be for a smaller bank. Additionally, some critics argue that mergers like this can lead to a lack of competition in the banking industry. With fewer players in the market, consumers may have fewer choices when it comes to banking products and services. this lack of competition could result in higher fees and less favorable terms for consumers. So another catastrophic failure has been avoided for now, but if bank failures continue to happen, there may be a breaking point in the markets that we need to keep our eye on. I hope you found this video entertaining and learned something new. If so, kindly click the like button and subscribe to the channel. Don't forget to tell your friends about the video too. Additionally, if you have any questions or remarks, please comment below. Thank you for watching, and if you enjoyed this video, why don't you check out the video we made on how much you need to save by age. See you in the next video.